Welcome to the Deep Dive. Today, we are tearing into the Q2 2025 earnings call results from eHealth.
Yeah, results that really lit a fire under the stock. We saw an immediate, strong, positive reaction.
A massive surge, really. It feels like it fundamentally changed the narrative for a company that's, been very focused on this transformation journey.
Absolutely. And what's fascinating here, I think, is that the market wasn't just reacting to perfect headline numbers.
No, not at all.
It seemed much more about demonstrated operational discipline and this huge confidence boost in future execution.
Right. So our mission today is pretty simple. Figure out how a company posting a GAAP loss managed to pivot the whole investment story in just one quarter.
Exactly. It's a deep dive into cost control. A bit about AI, actually, and this strategic validation of their balance sheet, all happening just before the critical annual enrollment period, the AEP.
Okay, let's unpack this then. We should start with that headline snapshot, the numbers that sort of set the stage, because on the surface, they looked a bit mixed, didn't they?
They absolutely did, yeah. Revenue for Q2 came in at $60.8 million. Now, that was an 8% decline year over year.
Okay, so a decline there.
And the GAAP EPS was a net loss, $0.98 per share. However, and this is key, management was really quick to point out they still beat their own internal revenue and profitability expectations.
Okay. So they guided conservatively, perhaps, or just executed better than planned internally. And the market clearly zeroed in on the operational cleanup aspect.
Precisely. You look at Adjusted EBITDA for that operational signal, right? The Adjusted EBITDA loss was $14.1 million.
Which is actually better than last year.
It is. Yeah. An improvement compared to the $15.5 million loss a year ago. So the key signal here is that the market rewarded the trajectory.
The direction, not just the snapshot.
Exactly. And the forward guidance. They basically looked past the Q2 decline, probably chalking it up to seasonal volume dips, and confirmed, okay, this cost restructuring, it's working.
So let's get granular on that cost restructuring. The numbers suggested, pretty targeted cuts, not just hacking away everywhere. How significant was this financial discipline?
It was quite significant. Total operating costs and expenses slashed by 11%, down to $83.8 million.
Okay, 11% overall.
But the really eye-popping number was in client acquisition. Medicare variable marketing spend was cut by a massive 24%.
Wow, okay. 24% reduction in marketing spend. Right before AEP, the busiest season. That sounds potentially risky.
It could sound that way, yeah.
Was there any sign this was purely surgical, or are they maybe jeopardizing future growth just for short-term profit?
That's the million-dollar question, isn't it? But the data suggests it was surgical. They managed this cut while actually improving their unit economics.
How?
They focused on trimming the less efficient marketing channels.
Yeah.
Cutting the fat, basically the spend that wasn't bringing in those high-quality, high-retention members.
Got it. Focus on quality, not just quantity.
And this intense focus on efficiency is what drove the Medicare segment's gross profit up by 26% in the quarter, and actually 47% for the first 6 months.
26% jump in Medicare gross profit. That certainly backs up the surgical cuts argument. And that focus on Medicare seems absolutely central, especially when you look at the other segment's performance.
Exactly right. Medicare revenue is $58.1 million. That was down just 2% year over year, so pretty resilient in the core business.
Stable, basically.
But contrast that with the employer and individual segment. That fell off a cliff, down 59% to just $2.7 million.
Oof, okay.
So the strategy is clearly a double down. Optimize the heck out of the Medicare vertical.
Okay, now let's get into something crucial for investor confidence in this space. The long-term value, or LTV validation. What did we see in the tail revenue that supports the quality of their existing book of business?
Yes, the tail revenue. This is where it gets really interesting, and it kind of validates those marketing cuts we just talked about.
How so?
Well, the reported revenue included a positive net adjustment revenue. That's the tail of $17.8 million.
$17.8 million positive adjustment.
Yes. And for listeners who follow this space closely, that net adjustment revenue is critical. What it basically means is that their historical guesses about member retention and future cash flows, they were actually too conservative.
So the policies are sticking better or paying out more commissions over time than they originally modeled.
Precisely. Seeing a positive adjustment like this, it really reinforces investor confidence in their LTV assumptions. It confirms the book of business they've built is high quality and performing well.
So spending less on marketing, but the customers they do have are proving more valuable over time. Let's talk about that conversion improvement too, because those numbers were, Huge.
Absolutely massive. Okay, so get this. They decreased the variable marketing cost per approved MA equivalent member by 7%.
Okay, slight decrease in cost per acquisition.
But at the same time, they achieved a staggering 50% conversion improvement in their online unassisted channel.
50%. A 50. In unassisted online.
50%.
That's not just an improvement. In an industry built on call centers and agents, a 50% jump in people just signing up themselves online.
Yeah.
That's a potential game changer for profitability.
And it's directly enabled by technology. They talked about successfully piloting and now scaling AI voice agents.
The AI angle.
Yeah, using them to handle call screening. Think about the staffing crunch everyone faces during peak AEP. This AI capacity is expected to materially improve answer rates.
So getting callers to the right licensed agent faster.
Or even better, letting the customer maybe self-serve more effectively if the AI can guide them initially. This tech leap is really central to how they maintain strong operational metrics while cutting those variable costs.
Okay, so this operational stability, these successful unit economic improvements, that clearly gave them the confidence for the big news. The guidance raise, this seemed to be the main driver for the stock jump. What are the new targets for 2025?
The raise was substantial, no doubt about it. Full year 2025 revenue guidance was lifted to a range of $525 million to $565 million.
Which was up from, what, 510 to 550 previously?
Correct. So a decent bump on the top line.
But the real story, reflecting that operating leverage we keep mentioning, was on the profitability side.
Oh, dramatically so. Adjusted EBITDA guidance was raised substantially. The prior range was $35 million to $60 million. The new range is $55 million to $75 million.
That's a huge lift at the midpoint.
It is. And they also showed that conviction in their LTV quality by raising the expected positive net adjustment revenue, that tail revenue again, to $29 million to $32 million for the full year.
And sticking with LTV, what did the constrained LTV refresh actually show? This is always a key technical signal for those watching closely.
Right, the refresh was, well, validating. Medicare Advantage LTV was up just 1% year over year, sitting at $934.
Okay, slight increase.
But Medicare Supplement LTV, a massive 29% increase, hitting $4,435.
Whoa, 29% on MedSup LTV. Where did that come from?
Two main drivers. One, simply better retention. The policies are sticking longer. And two, crucially, they actually reduce the constraint they use in the LTV model itself.
Okay, hold on. For our listeners, why does reducing that LTV constraint matter so much? What does that signal?
It's a really key signal of management confidence. See, the constraint is basically a risk discount they apply when calculating future cash flows from a policy.
Like a haircut they take off the expected value just in case.
Exactly. So when they reduce that constraint, and that reduction accounted for about 7% of that 29% LTV increase, by the way, it means their actuaries and leadership are mathematically more confident in the stability and the duration of those future commission payments.
So it's not just wishful thinking, it's a systematic change reflecting stronger expected retention and cash flow predictability.
Precisely. It's a tangible sign of improved underlying business quality.
Okay, let's shift gears now to the upcoming annual enrollment period. Management seems to be framing the expected industry turbulence almost as a strategic opportunity for them.
Yeah, they definitely are. They said they anticipate a dynamic and complex AEP.
Why dynamic and complex more than usual?
Well, the feeling is that persistent carrier margin pressure, the insurance companies feeling squeezed, is likely going to lead to continued benefit cuts, maybe shrinking service areas.
Fewer attractive plans for consumers, maybe?
Or even potentially some plans becoming non-commissionable for brokers altogether.
Okay, that sounds like potential chaos for consumers trying to navigate their options. Why is that necessarily good for eHealth?
Because, theoretically, when the market gets chaotic and confusing, consumers need impartial, trusted guidance more than ever.
The advisor role becomes more valuable.
Exactly. The company believes this disruption lets them differentiate themselves as a sophisticated omni-channel advisor, helping people steer through that complexity. So this anticipated volatility is actually a key reason they feel they can maintain strong enrollment expectations, even if the overall market is choppy.
Interesting positioning. We also need to touch on the regulatory context. There was a favorable tailwind mentioned that's apparently not even fully baked into that big guidance raise yet.
Yes, this is a significant potential upside catalyst down the road. The maximum broker commission rates for plan year 2026 were announced, and they came in higher than prior assumptions.
Good news for brokers.
Definitely. And management explicitly stated they have not fully incorporated the impact of this commission rate increase into their updated 2025 guidance ranges yet.
Wow. Okay, so that leaves real room for potentially another upward revision later this year, or just makes hitting the current high guidance more likely.
That's the implication, yes. It's like having a bit of good news in your back pocket.
That's a huge piece of strategic info for investors. The guidance is already high, and there's still potentially unbooked upside.
Correct. The only real headwind they noted on the regulatory front was a change limiting how often dual-eligible beneficiaries can switch plans. That apparently dampened enrollment a bit in Q2 and Q3.
Okay, a negative impact there.
But management seems to think this volume isn't lost. It'll just shift and mostly be recaptured during the main Q4 AEP window. So more of a timing shift than a permanent loss.
Okay, let's pivot finally to the broader strategic picture. Balance sheet, leadership transitions. The company's biggest asset by far is that commissions receivable number. How big is that now?
That asset totals $917.0 million. It's massive.
$917 million.
And it really is the engine underpinning their future strategic moves. So they made it clear they're actively progressing towards a capital transaction centered around this very asset.
Right. What are the main goals of this capital strategy? They laid out 3, I think. And why was that nuance about not a securitization seemingly so important?
Okay, the 3 goals are, first, deal with the term loan that matures in February 2026. That's coming up.
Get that refinanced or paid down.
Second, increase their access to capital for profitable growth opportunities. And third, and this connects back to everything we've discussed, validating the value of that massive $917 million commissions receivable asset.
Validating the value.
And yeah, they specifically stress this is not a securitization in the conventional sense.
Why draw that line in the sand? Why make that distinction? What does it signal?
It feels like a crucial nuance for the market. They're signaling they aren't just, desperately selling off future cash flows for quick liquidity today, which can sometimes carry a stigma or involve complex accounting.
Right. It can look like factoring receivables at a steep discount sometimes.
Exactly. Instead, they seem to be aiming for a transaction structure that primarily validates the quality and the valuation of the asset itself, linking directly back to all that hard work on LTV and retention we talked about.
So the validation itself is almost as important as the cash.
Arguably more important for long-term investor confidence than just the immediate cash proceeds. It proves the model works and the asset is real and valuable.
And that third strategic goal they mentioned, dealing with the convertible preferred instrument that's still out there, but not part of this immediate transaction.
Correct. That remains a goal, they said, but they don't expect to tackle it in this current transaction process, which is really focused on the term loan and getting growth capital.
And finally, we have to acknowledge the leadership change happening right as they head into the busiest time of year.
Yeah, Franisman, the current CEO, is stepping down next month. But critically, he's not just disappearing. He'll transition to an advisory role, specifically through AEP.
Okay, so ensuring continuity during that peak season, that's important.
Very important. And the new CEO is Derek Duke. He's been appointed, bringing deep experience from previous leadership roles at places like Health Markets and Mellon Health.
So he knows this space well.
Seems like it. His background in managing complex health distribution platforms looks like a good fit for navigating the kind of dynamic AEP they're expecting.
And just to round out the context, they continue to mention the DOJ False Claims Act complaint as a standard risk factor in their filings, right? Along with that general uncertainty over how big the ACA subsidies will be for 2026, which Congress still needs to sort out.
Absolutely. The regulatory environment, plus the anticipated market disruption. It's certainly going to be a true test for the new CEO right out of the gate.
It definitely sets the stage. And that leads us perfectly into our final segment. Let's talk about a trade idea. This is, of course, the not financial advice segment.
That's right. As always, this is purely for discussion and entertainment. Please consult your own financial advisor before making any investment decisions based on anything you hear here.
Okay, disclaimer delivered. So, given everything we've discussed, the raised guidance driven by those surgical cost cuts, the tech leap with AI, and especially this explicit strategy to validate that nearly $1 billion commissions receivable asset, what's the outrageous but plausible trade idea stemming from this deep dive?
All right, we're pitching this as the receivable monetization catalyst trade.
Okay, receivable monetization catalyst. I like it. What's the structure?
The premise is pretty straightforward, structure-wise.
Yeah.
You go long the equity, eHealth stock, and you finance that potentially by taking a short position in maybe a less diversified or a smaller regional peer company in the same space.
Okay, so a classic pairs trade, essentially. Betting on relative outperformance. Explain the catalyst that triggers that outperformance.
The bet hinges almost entirely on the successful closure of that capital structure transaction we just discussed. If they manage to pull off a deal that truly validates those $917 million LTV and receivable assumptions,
If they prove the asset's value.
right, that unlocks immense balance sheet flexibility. Flexibility that smaller regional peers simply don't have access to. That successful transaction, coupled with the AEP execution, hopefully boosted by the new AI efficiencies, validates the company's scale and the quality of its customer book.
And that combination should lead to
A significant re-rating of the stock. In theory, it should cause it to outperform those peers who just lack the scale, the tech, and crucially, that high-quality receivable base needed to execute similar strategic moves, especially in this volatile market we expect.
So it's really a bet on the balance sheet strength and the enabling technology being the ultimate differentiators in a tough market.
That's the thesis. Betting on that capital structure validation as the key catalyst.
That is a compelling thesis, I have to say.
We think so. Especially because, as we said, flexibility is absolutely king when you know you're heading into a dynamic and complex enrollment period.
Okay, so to quickly recap our deep dive, we saw impressive surgical cost execution driving really significant profitability increases.
That's it.
A big guidance raise, which was itself validated by LTV refinement and that positive tail revenue.
Got it.
And clear strategic positioning using technology like AI to try and gain share amid expected carrier disruption heading into AEP. The market clearly loved this pivot towards controlled, profitable growth.
Absolutely. The narrative seems to have shifted. It's maybe less about just transformation now and more about utilizing their scale and operational rigor to actually dominate during market volatility.
Which leaves us with one final provocative thought for you, our listeners, to chew on. With all this expected disruption in the insurance landscape during AEP this year, mainly because of those carrier margin pressures, will this volatility ultimately lead to long-term market share consolidation? Will the biggest brokers, like this one potentially, just get bigger?
Or will those enhanced digital tools, like the AI systems they're deploying, actually democratize access and allow smaller, maybe more nimble and efficient players to weather the storm and successfully defend their niches?
The classic battle. Massive scale versus surgical technology and niche focus. It feels like that battle is really just beginning in this highly regulated sector.
It certainly does. Lots to watch.
We'll leave you to ponder that question. Thanks for joining us for this deep dive. Remember, knowledge is power.